Welcome to PIMCO Pod. In this episode, we discuss that, with spreads tight and dispersion rising, the tools investors use to judge performance matter more than ever. Stay tuned after the conclusion of the podcast for additional important information. Measuring What Matters in Public and Private Fixed Income by Lotfi Karui. Despite the move lower late last week, U.S. Treasury yields are still holding well above recent lows and close to highs not seen in more than a year. By contrast, risk assets are firmly bid. U.S. equities have been routinely touching new historical highs, and credit spreads over Treasuries remain tight. The playbook is unchanged. Risk assets continue to price a resolution of the Iran conflict and are willing to look through some inflation reacceleration so long as growth holds and fundamentals stay supportive, both of which have been the case thus far. Bonds will likely keep discounting a wider range of potential monetary policy outcomes and also embed a higher war-related risk premium that, if tensions further de-escalate, has room to compress. This is only one example of the many fundamental differences between risk assets, and equities in particular, and fixed income. Measuring what matters: active versus passive. The debate about active versus passive management in fixed income has never been resolved, and the reason is structural, not empirical. Any comparison between the two faces three distinct hurdles. First, performance must be measured on a like-for-like basis, which requires controlling for survivorship bias by including merged and liquidated funds, rather than implicitly treating them as underperformers or excluding them altogether. Second, selecting the appropriate benchmark is inherently more complex in fixed income. Third, and most critically, the comparison should be against an investable passive strategy, not a theoretical benchmark that no investor can actually own. This last point is where most comparisons break down. Bond indices, while useful as broad measures of an investable universe, are not portfolios anyone can hold. Aggregate and corporate indices, and especially securitized bank loan and emerging market bond indices, are closer to accounting constructs than tradable, observable portfolios. They assume month-end rebalancing at the mid-price, costless absorption of new issues, real-time treatment of rating migrations, and full inclusion of thousands of line items that trade by appointment rather than in liquid, transparent markets. Replicating this universe in a portfolio is simply not possible. As a result, measuring active fixed income performance against these paper indices conflates the cost of investability with manager skill. Index ETFs make that cost visible. A passive vehicle has no selection mandate, yet it persistently lands below the benchmark, dragged down by fees, transaction costs, and sampling discrepancies. The average annual total return differential relative to the benchmark for the top 5 passive ETFs in the high-yield HY market, measured by assets under management over the past 10 years. The pattern is predominantly negative, meaning that when judged by the same benchmark relative logic applied to active managers, passive essentially underperforms itself. The real test, then, is not active return against a theoretical index, but against what an investor could actually have earned in a passive vehicle, fees included and ideally risk-matched. Measured that way, the evidence is clear. Active fixed income beats passive most of the time. The fraction of active fixed income funds and ETFs that outperform their benchmark indices versus those that outperform their median passive peers are performed net of fees using a 5-year look-back window as of year-end 2025. The results are similar when using a 10-year look-back period. Our universe also includes merged and liquidated funds and therefore corrects for any potential survivorship bias. Across various styles, the fraction of active funds that outperform their median passive peers is quite high. The ratio of outperformers also increases over longer horizons. The evidence shown is consistent with a large body of academic literature. With spreads at historically tight levels, the compensation for indiscriminate exposure is thin and the asymmetry unattractive. At the same time, dispersion is rising. When valuations are rich, managing downside risk is first and foremost about avoiding positions the index forces on a passive holder. When dispersion is high, doing the credit work in both public and private markets can pay off to capture the upside. In our view, these are precisely the conditions where passive replication is most costly and active management may be most valuable. No benchmark, no problem? Not quite. Much of the attention in private credit has focused on redemption pressure in non-traded business development companies, BDCs. But 5 months into the year, fundraising in drawdown funds looks mixed at best. The number of newly launched direct lending funds, on a run rate basis, remains very low, while the number of funds reaching a final close has also declined materially. Further, the time from launch to close continues to set new highs. These figures will likely be revised, but the direction is clear. Institutional appetite for direct lending has cooled, and financing conditions for borrowers are tightening at the margin as a result. Beyond the fundamental headwinds facing direct lending portfolios, the shrinking excess premium over comparable public markets has also weighed on demand. This brings into focus a deeper issue: how to measure that excess premium. And in private markets, the problem runs in the opposite direction of public markets. There is no benchmark at all, and that absence invites the comfortable illusion of costless outperformance. But the lack of a yardstick does not mean direct lending consistently outperforms a viable alternative. A more appropriate comparison exists: a modestly leveraged exposure to the broadly syndicated loan market. Viewed through that lens, private credit is not benchmark-free. The excess return, net of fees, generated by direct lending vintage funds versus a leveraged broadly syndicated loan index using a public market equivalent PME framework. Stripping away technical details, the PME approach estimates the excess return that must be added to the leveraged broadly syndicated loan index so that the net present value of the fund's cash flows equals zero. Intuitively, this measures how much additional return the fund has generated relative to what investors would have earned by investing the same cash flows in the leveraged public broadly syndicated loan index. These results capture both investors' compensation for illiquidity as well as any additional benefit from manager selection. The takeaway is straightforward. The pre-COVID vintages delivered solid compensation relative to public market equivalents, reflecting stronger underwriting discipline and greater scope for manager skill. By contrast, recent vintages have seen a steady decline in excess returns. Put differently, recent vintages of direct lending portfolios appear to increasingly resemble a beta product, with returns driven more by broad credit conditions than by manager skill, much like a passive exposure. Thank you for listening. That was Measuring What Matters in Fixed Income and Private Credit. For future insights, please follow us on your favorite podcast platform. This episode uses an AI-generated voice. The discussion and content provided within this podcast is intended for informational purposes only and may not be appropriate for all investors. Reliance upon information provided in a podcast is at the sole responsibility of the listener. The information included herein is not based on any particularized financial situation or need and is not intended to be and should not be construed as a forecast, research, investment advice, or a recommendation for any specific PIMCO or other security, strategy, product, or service. Past performance is not a guarantee of future results. All investments contain risk and may lose value. Investors should speak to their financial advisors regarding the investment mix that may be right for them based on their financial situation and investment objective. Podcasts may involve discussions with non-PIMCO personnel, and such content contain the current opinions of the speaker, but not necessarily those of PIMCO. Other podcasts may consist of audio recording of an existing PIMCO article, and such material contains the current opinions of the manager. The opinions expressed in all podcasts are subject to change without notice. Information contained herein has been obtained from sources believed to be reliable, but not guaranteed. PIMCO, as a general matter, provides services to qualified institutions, financial intermediaries, and institutional investors. This is not an offer to any person in any jurisdiction where unlawful or unauthorized. For additional important information, go to www.pimco.com/gbl/en/general/legal-pages/podcast-disclosures.